Hello everyone, welcome back to another installment of our Lunch and Learn webinar series. I'm your host, Mayur Thaker, and this is another update to the ongoing macro-related discussion that we've been having for quite a while now. And if you've been following me, if you recall, I've been bearish on the market, I've been bearish on the economy for some time. And so now we're going to unpack that a little bit and look at what happened. So if you've been following me, I've been talking about how certain indicators that I watch are moving in the wrong direction, and they have consistently moved in the wrong direction. And so I wanted to show you those 9 or 10 charts that I was watching to base the call that I made regarding recession. Originally, I thought that recession would take hold in the US by the end of 2023. That never happened. We're now completely done with 2024 and well into 2025 now. And yet there still is no sign of recession in terms of coincident indicators starting to join the leading indicators that I was watching. So keep in mind, I was looking at leading indicators, or at least indicators that I believed were leading, but ultimately coincident indicators need to ultimately join the leading indicators for the recession to actually happen. And so I believe that since leading indicators were in contractionary territory for an extended period of time, I had believed and made the case right here on this channel that I believe that coincident, meaning more immediate indicators, the more mainstream indicators that economists use to determine whether or not we're in recession, would ultimately catch down to the leading indicators. So let's look at what those leading indicators were and why I believed all this time that we were heading into recession. So I've titled this discussion, The Recession That Never Arrived. So what happened and where do we go from here? So this is our latest installment as of January/February 2025. So let's look at some of these numbers and charts that I've been watching and presenting to you right here on this channel. So like I said, I've made since Q2 of 2023, I believe that we were descending into recession because I saw a series of 10 market and economic data crossing thresholds that historically have only happened during recessions with few to no false signals. However, there's a first for everything, and it turns out that these recession signals collectively gave their first false flag ever. And so I want to admit it right here, I was wrong. I was wrong about that. So let's take a look and do a post-mortem as to what these indicators that I was watching were and what they're saying now. The first one, ISM Manufacturing. I was watching this like a hawk, as you've noticed. I've been using this as one of the main reasons why I believe that we were descending into recession. And as you can see here, just looking at it going back 25 plus years, every time the yellow line here, that is the ISM Manufacturing PMI, this is the most widespread and well-cited survey of manufacturing activity in the United States. And every single time it drops sustainably below 50, which means that the manufacturing sector is in contraction, the broader economy has followed suit. And this has been a leading indicator. So if you run a regression, you will see that the S&P 500 shares a 70% correlation with the ISM Manufacturing in terms of earnings. That is, S&P 500 earnings shares a 70% correlation. And so every time we have dipped into contraction for ISM, the S&P 500 earnings have always followed suit. And here you can see in the dark red is the S&P 500. And then I've also broken out the Zacks Cyclical Proxy as well. I should have used a better color scheme here so you can differentiate the two. But the Zacks Cyclical Proxy moves even in advance of the S&P 500. So you can see that the ISM Manufacturing shares an even stronger correlation. In fact, if you run a regression against the Zacks Cyclical Proxy, that is the component of the S&P 500 that is truly cyclical in nature. These are more mature businesses. They move even in advance of the S&P 500, and every single time the ISM Manufacturing has dipped below 50, as you can see here, we have just 49. So if you just imagine it, that being 50, every single time this is, dipped below 50 for a sustained period of time. I'm not saying a single month or two, but 3, 4, 5, 6 months. The S&P 500 has then also descended into earnings recession. And the same thing happened here where we dipped below 50, and it's been below 50 for the better part of 2.5 years. But the S&P 500 never truly actually went into a recession. Even though the S&P cyclicals remain in recession in terms of an earnings recession, the S&P 500 has not actually been in an earnings recession. So this was kind of the first false flag that we can use here. So if I look at the statistics, right, U.S. manufacturing has been in recession now for 25 of the last 27 months. This has historically been a leading indicator for S&P 500 earnings growth. The extended contraction in ISM foretold an earnings recession for the S&P 500, as it historically has. This worked for S&P cyclicals, which, if you go back, you can see cyclicals have, in fact, been in an earnings recession. But the S&P 500 aggregate never really did. Whenever cyclicals enter recession, the broader economy has always reliably entered recession. And that too for a sustained period of time. It can't be for just a month or two or a quarter, but for 2 to 3 quarters, yes. And yet it's been 9 quarters, almost 10 quarters now, where the S&P cyclicals have been in recession. But it did not reflect on the aggregate S&P 500. And the reason for this is because the index is now dominated by software and technology stocks, riding a very strong secular bullish tailwind within AI, right? Historically, S&P cyclicals have had a much better track record at explaining the movements of the S&P 500. But now, because the S&P 500 is so top-heavy in the Mag 7, in the top 10, these top 10 companies are no longer cyclicals, or at least, in another way, cyclicals are now a much smaller component of the S&P 500 index as they once were. And so now S&P cyclicals are just not as important, just plain and simple, as they used to be. And now what happened is the ISM, as you can see through the latest print through January, has now returned to expansionary territory and the best reading that we have had for more than 2.5 years now. So this is the best print in 27 months, almost 2.5 years. So this was the first false flag. We were, in recession for manufacturing. That correctly foretold an earnings recession for S&P cyclicals. But because cyclicals are now a much smaller component of the S&P 500, that relationship has broken down. And so I made the mistake of, making the connection that ISM Manufacturing is therefore bearish. ISM Manufacturing being in contraction is therefore bearish for S&P cyclicals. S&P cyclicals being bearish is therefore bearish for the S&P 500. The first connection held up because, as you can see here, S&P cyclicals are still in an earnings recession, but the second step of that, meaning that having an implication on the S&P 500, never really carried through. And as you can see here through the latest quarter, the S&P 500 is showing very strong growth at 9.5%, 9.7%. So the connection that we had to cyclicals worked out, but I erroneously and mistakenly assumed that as go cyclicals, so go the S&P 500. Historically, that's been true. At every point in the past, every time cyclicals descend into recession, the S&P has also descended into recession. But now that relationship has been broken because the big 10 companies of the S&P 500 are not cyclicals. They are secular growth companies. Companies like Amazon, Microsoft, Nvidia, Tesla, those types of companies. So, manufacturing is just not as important of a sector as it once was. The S&P composition has dramatically shifted away from cyclicals such as retail, transportation, energy, banking, and towards secular technological growth, primarily those big 7 companies I just mentioned. And so false flag number 2, as I just mentioned, cyclicals in an earnings recession. Again, the reason why cyclicals are important is because these companies are mostly mature businesses with limited growth potential, and it's important to track these companies because their financial performance is a direct reflection of the state of the business cycle, right? And these companies have collectively been in an earnings recession now for 10 consecutive quarters. Never in history has this happened without the broader economy falling into recession, except now. So this was the first time that relationship has broken down. ISM Manufacturing PMI, as I mentioned, shares a 77% leading correlation with these companies. And it correctly called their downturn. And that's why I've been bearish on the market, because as the cyclicals go, so does the S&P 500. Historically, that's been the case. And so while the ISM Manufacturing weakness has correctly called the downturn of cyclicals, the cyclicals in an earnings recession has not translated to the S&P aggregate entering an earnings recession. So this was the first time that relationship has ever broken down in over 25 years. And now the exact opposite is happening. It looks like manufacturing is finally exiting the doldrums that it's been in for almost, for 27 months now. And it looks like it wants to get back into expansionary territory. Now, 1 month doesn't make a trend, but this is a really nice rounded bottom that we see here, where it looks like it's making higher highs and higher lows each time. So if this can sustain this expansion, where we have multiple months of ISM Manufacturing above 50, that would be very bullish for the S&P cyclicals, which would in turn be bullish for the S&P 500, because that would broaden out the earnings growth that we have seen thus far, which for now have been largely concentrated in just the 10 biggest companies. Here's the other false flag. The Treasury yield curve inverting into negative territory. Now, historically speaking, if you look at it, just looking at the history of this chart, 50 years of history shows us that every time we fall below 0, right? If you just look at the chart here, every time the 10-year Treasury yield minus the 2-year Treasury yield, right? This is the 10-year, this is the long end of the curve minus the short end of the curve. Every time this series has fallen into inversion, meaning below 0, we have been in a confirmed recession not too long after that. Here you can see the inversion happened back in the late 70s, and we had that confirmed recession in 1979, 1980. And that was marked with a period of, multiple recessions back to back here within a short time frame. But here we saw it again in the late 80s with a confirmed recession in the early 90s. Here we had another, inversion with a confirmed recession about a year later. Here another confirmed inversion with a confirmed recession a year later. And now we had an inversion, and now it's been more than 2 years and no confirmed recession. So never in over 5 decades has the 10s minus 2s inverted without a recession following within 6 to 24 months. So the inversion that began in July 2022 was the first exception to that rule. So this was truly unprecedented, folks. Here, again, ISM Manufacturing has never gotten it wrong. It got it wrong. Cyclical is entering an earnings recession, has never gotten it wrong before. It got it wrong now. Here we have the U.S. Treasury yield curve, has never gotten it wrong in 50 years, and it got it wrong now. This was the first exception to the rule. Here's another chart, which is truly amazing. This is the unemployment rate in the U.S. And what I've shown here is the unemployment rate overlaid with the 3-year moving average. Every single time the unemployment rate has built up some momentum, defined as crossing over the 3-year moving average. So here I have it as an EMA 36 months. So that's a 3-year moving average. That's the yellow line. Every single time the unemployment rate has gained momentum and crossed over the 3-year moving average, I'm not saying crossing below, but crossing above it from below it, right? Every time it's crossed above it, we have been in a confirmed recession within 6 to 12 months from that happening. Here we see it here. Now there was a recession right here, which I don't have it in shaded. It's not actually shaded here, but there was a recession right here in I believe 1969. If I'm not mistaken, that was a confirmed recession. It's just not shaded. But here we have a crossover, confirmed recession. Crossover above, confirmed recession. Crossover, and that was, a back-to-back recession. So it was already in a bullish wave. That could technically be just one long recession. Here we have a crossover, recession. Crossover above, recession. Crossover above, recession in 2008. Now, with COVID, we didn't really have any reaction time because that was just a freak of nature. Now look at what we're at now. We had a crossover above and no recession. No recession. Truly amazing. Never in over 6 decades has the national unemployment rate crossed over its 3-year moving average without a significant escalation into recession within 6 to 12 months. The crossover that started in July of 2024 has failed to gain any momentum. You can see that every time it's crossed above it, there was a clean break, and we saw significant escalation, meaning clear momentum building to the upside in unemployment. Remember, unemployment is one of these things that acts like a domino because, as one person loses their job, that changes their consumption behavior, and therefore that triggers more unemployment, right? Because as somebody, eats out less, for example, then that reduces the revenue of that one restaurant, which means that one restaurant places that much less of a order to its suppliers, which then leads to, it cascades down, ultimately leading to job losses downstream or upstream in the supply chain. So, as revenues get pinched, ultimately what happens is companies then have to downsize. If enough of that happens, companies then are forced to downsize. And that's why unemployment is one of these things that really, freaks out central bankers. They really don't want to see unemployment building momentum because once you build momentum, it's really hard to put the genie back into the bottle. It's really, really difficult to stop it. And that's why you can see every single time, and there's nothing magical about the 36-month moving average. I could have made this, I guess you could make it 48 months. I guess you can make it a clean 5-year moving average, whatever the case is. But, I just use this because there's been no false positives going back 50 years, 60 years, in fact. Every time it's crossed over the 36-month moving average, we've had building momentum to the upside As you can see, a clean break above, a clean break above, a clean break above, clean break above. And yet this time, there was a break above, and now it's just kind of coasting sideways. That was the first time that's ever happened. So that crossover that started in July of last year never gained any momentum. Now maybe it still gains momentum. We'll have to see that. But this time it really feels like it's different. It's just not acting in the same way that I expected it to act. So that was the first exception to that rule. In a similar note, permanent job losers. See, the unemployment rate is affected by not just the total number of people that are unemployed, but it's also a function of the total labor force. So if fewer people are looking for work, then that could artificially depress the unemployment rate, and therefore it doesn't show up, and you don't think anything is wrong. So that's why I look at both the unemployment rate and sort of the numerator of that equation, which is permanent job losers. It's just one component of it. But I look at permanent job losers and do the same exact analysis. Look at permanent job losers in a total, figure, an absolute number, not a percentage like the unemployment rate is, but as an absolute number, and look at that relative to its 36-month moving average or 3-year moving average. And the same thing has been observed every single time. Now, there's not a lot of history to this, but you can still observe a very similar behavior every single time unemployment has built up some momentum such that it crosses over the 3-year moving average. We've had a clean break above and a cascading recession very soon thereafter. You saw that this break happened just before the 2001 recession. This break above happened just above the 2008 recession. This break above, again, COVID was just a freak of nature where nobody could have predicted that. So that's kind of an exception there, not even a real recession, I would say. But here you saw, yet again, a break above, but no clear direction. That's never happened before. So never in 3 decades has permanent job losers crossed over its 3-year moving average without a significant escalation into recession within 6 to 12 months. That crossover that first happened in January of 2024 has failed to gain any momentum. Again, yet another first among many. Here is an even better gauge of the labor market. This is the Kansas City Fed Labor Market Conditions Index. This is amazing because this is probably the most comprehensive index constructed from 24 unique leading and coincident indicators that measure the strength and breadth, more importantly, the breadth of the job and labor market. This is a very, very comprehensive index. And as you can see, never in its 30-year history has the index fallen below its 3-year moving average without a recession following. Here you can see that this drop happened just before that 2001 recession took hold. This drop below happened just before the 2008 recession took hold. And look at where we are here. This drop below happened, it started in August of 2023. And we never got a recession. We just never got it. And now it's starting to bounce back a little bit. So again, this was yet again a first false signal in multiple decades of history. Here's another example. I've been talking about this, which is true private payroll growth. This is looking at the true private sector job growth on a 3-month moving average. As you can see, historically speaking, during healthy bull markets, the private sector generates somewhere between 100 to 200,000 jobs a month. As you can see here, during healthy months. Now, sometimes it does slow down, but then it recovers quite quickly within a couple months. So as you can see here, during bull markets, right, during the 80s, during the 1990s, during the mid-2000s, during the 2010s, job growth has been a steady 100 to 200,000, sometimes even above that. And yet, look at that right here. We have been in a private sector job drought now for many months. Never in its 40 years of history has the 3-month moving average of true private payrolls. Now, I define this as total non-farm payrolls. That's the number that we get as the headline number every month from the jobs report. But then I subtract out government, healthcare, and education, because these are basically government or government adjacent industries. So I like to look at total payrolls minus these government sector jobs, because we are, it's very important to look at how the true private sector is doing with regards to hiring. And never in these 40 years has this series entered contraction without a confirmed recession. We reached it in August of 2024. And again, very similar to that, never in 50 years has government's contribution to total job gains crossed above 60% without a recession following shortly thereafter. We reached 64% in August. So what this means is, if you look at the contribution of where the jobs are coming from, whenever government or government adjacent industries, meaning healthcare and education, whenever these industries contribute more than 60% of all jobs created over a 12-month period, we have descended into recession, meaning there's too much dependence on government and not enough private sector job creation. Whenever that has crossed above 60%, every single time in 50 years of data, we have, descended into recession. We reached 64% in August. So August 2024 was the first false signal with regards to this. Truly remarkable. Here's another way to look at it, another false flag. Here are the revisions to non-farm payrolls. Remember, every time we get the jobs report each month, the government not only tells us how many jobs were created in the most recent month, but it also revises prior months. Sometimes the revisions are positive, and sometimes they're negative. And if you look at it, over the last 12 months, the extent of the revisions were so negative. This is consistent only with recessions. If you go back to this, now, if you look at it over here, the only time we had truly negative revisions without a recession was right here in the 1980s, right in the mid-80s, like 1985 through 1987, right? These were quite negative revisions as well. But it actually got even worse than that most recently over here. So we actually, broke even below that number. And as you can see here, the only times we've ever had negative prior month revisions to this extent and for this long has been in confirmed recessions in the past. So again, yet another false flag. Truly amazing. So November 2023 was the first false signal. Never in 50 years has the extent of prior month non-farm payroll revisions have been this negative for such an extended period of time, again, without a recession following. Yet another false flag. Here's another false flag. Transition into serious delinquency. This is a chart from the New York Fed. Remember, the New York Fed publishes data like this every quarter, which looks at consumer debt, household debt, loan delinquencies, things like that. And this chart is truly shocking because, as you can see here, credit card debt, this is looking at transition into serious delinquency, 90 plus days, by loan type. So this looks at the percentage of accounts, total accounts, that are transitioning into serious delinquency. And this number hit highs for credit cards and auto loans, the highest levels since the great financial crisis. So you can see the student loans really plummeted here because that, as we know, under the Biden administration, we had significant student loan forgiveness plans go out. And so you can see what the effect of that was, where, we went from significant delinquency on student loans to basically none. But in areas that haven't been given assistance, like credit cards and auto loans, credit cards are at the highest transition into serious delinquency going back to 2011. And that's basically when we were just exiting the great financial crisis. So if you look at it from the point of, going from below heading upward, that number hasn't been this high since we were entering the great financial crisis in 2007. Same thing with auto loan delinquencies, the highest number since entering the great financial crisis in 2008. Again, credit card and auto loan delinquencies, both as a percentage of total outstanding balance and as a percentage of accounts transitioning into serious delinquency, has hit levels not seen since we entered the great financial crisis in 2008. And this is being corroborated by companies like Capital One, American Express, Discover, who are all bellwethers of consumer financial health. And they have been reporting the highest ever loan loss reserve ratios since the great financial crisis. So again, this was yet again a false signal, yet another false flag. So I just showed, 10 different items that collectively gave a false signal of recession together. And these indicators have never given us such a false flag ever in its history. So, I was truly humbled by the fact that the U.S. economy is so incredibly resilient despite these headwinds that historically have never given us a false positive for an incoming recession. Leading indicators never truly affected coincident indicators the way that they normally do. So I was wrong about that. So the next question is that if these broad-based indicators have backed off of recession, where do we go from here? Well, number one, valuation risk still remains the top concern, even if recession risk is no longer, at least not in the present term, a top concern. Valuation risk still remains the top concern for me. If you look at this right here, this is one of my favorite charts, the Shiller PE ratio. This shows that equity valuations are reaching for the highest. It's actually in reverse here because this is looking at the earnings yield, which is showing the lowest, rate of attractiveness relative to bonds in more than 20 years. You can see going back to 2001/2002, that's where we're at right now in terms of the market's valuation. Valuations are currently implying significant earnings acceleration. We need to see earnings accelerate in a dramatic way to justify the current valuation. Thus far, the vast majority of S&P 500 earnings growth have been from just the top 10 companies, which have reached an unprecedented 40% of the index. That's very, very substantial. And as you can see on this chart, earnings growth has primarily come from, these 7 major tech companies. You can see the S&P total is up almost 10% year over year, which is great. But it's all coming from 7 companies. If you look at the black line here, that's the S&P 493. So if you remove just the 7 companies, earnings growth is very lackluster. However, I will give you one thing, which is one thing that is sort of the silver lining here, is that the trend is positive. At least we're exiting this earnings contraction and heading back into earnings expansion. So that's very good to see. However, another silver lining, I should say, is going back to this chart, right? ISM Manufacturing. This is a very bullish chart to me because, remember, the biggest reason why I've been bearish is because ISM has been bearish. But now ISM is bullish. And remember, ISM is a leading indicator to S&P 500 cyclicals, which still are a substantial component of the S&P 500. So Since ISM Manufacturing is bullish right now, and since ISM Manufacturing has a 77% leading correlation coefficient with the S&P 500 cyclicals, this would significantly ease one of the biggest concerns I have, which is that the burden may be broadening out. Right now, the burden is on the Mag 7 companies, right? The 7 companies are carrying the index right now. Without those 7, earnings growth basically falls to barely 2 to 3%. But if ISM Manufacturing continues this trend of strength, if manufacturing is coming back, right, partially due to Trump-era policies, remember, Trump is almost singularly focusing on U.S. domestic manufacturing, making manufacturing great again. If he is successful at doing that, if he's focused singularly on reviving American manufacturing, then this could be a very bullish outlook for manufacturing, which ultimately means that it would be very bullish for an earnings recovery for cyclical companies such as transportation, retail, consumer discretionary, and industrials. If these companies finally get back to growth, remember, these companies are still in an earnings recession, and it's been that way now for 10 quarters. Again, this is one of the reasons I've been bearish. Cyclicals are important. They are a big component of the S&P 500. We need cyclicals to get back to growth. Usually cyclicals are in growth. During most bull markets, cyclicals are a major contributor to earnings growth. We need them to get back to earnings growth to ease the burden on the Mag 7 carrying the market solely on its shoulders. So if ISM Manufacturing continues this strength, that would be very bullish for cyclicals, which would make the earnings growth broader, and that would increase the breadth of the market in terms of earnings growth, and therefore, stock price performance, meaning the number of companies that are gaining in the market would increase in breadth, right? Would increase overall. So this would be a very bullish trend if this continues. ISM as goes ISM Manufacturing, so goes S&P 500 cyclicals. And if cyclicals start to join the party, if they get back to growth, then the S&P 500 is going to accelerate meaningfully in earnings growth. So remember, Trump's economic policy agenda, the Department of Government Efficiency, DOGE, to bring large-scale cuts to the federal headcount, to bring a lot of efficiency back to government, to renegotiate trade deals, to put tariffs on countries who place restrictive tariffs on American exports, extending and potentially even adding to the tax cuts of 2017. There is potential for further reductions in the corporate tax rate from the current 21% to 15%. There's some talk of that. Treasury Secretary Scott Bessent has talked about that before. There is potential for tax code simplification and lower personal tax rates. We'll see where that goes. But also there is another aspect to the Trump administration, which I personally think is bearish, which is deportation of millions of illegal immigrants. So if you look at it, if I categorize it between bullish and bearish aspects, this is just my opinion. What's bullish is that if we renegotiate trade deals to make American exports more attractive abroad, or to incentivize foreign companies and even domestic companies to set up shop in the U.S., again, that would feed into this trend right here. That would, push ISM Manufacturing up back into expansionary territory. Remember, during bull markets, ISM is comfortably above 53. It could get up to even 57 to even up to 60. That's where we need to be to get strong earnings growth coming back from cyclicals. And so I believe that if this is the case, if President Trump is able to renegotiate trade deals to get a better deal to make American exports better, more attractive abroad, or to incentivize foreign companies and domestic companies to focus on U.S.-centric manufacturing. That would be very bullish. If we are able to bring the corporate tax rate down to 15%, that would make the U.S. among the lowest, among the OECD countries. That would be a magnet for investment and business formation. If we bring mass layoffs and cost controls to right-size the federal government, that would enable even further tax cuts, right? And that's what DOGE is currently focused on. If we have simplification of the tax code and the National Register in terms of the number of regulations that are imposed, that would be bullish. That would make the cost of compliance lower. Again, very bullish for margins, very bullish for business formations. If we get back to economic fundamentals, meaning savings, not debt, fuels growth. This is very important. Over the past, I would say 50 years, right? Debt has fueled growth. Deficits have fueled growth, except for a very brief period during the late 90s under President Clinton, where we had a very strong budget surplus. Except for that one period, we've had nothing but debt and deficits that fuel growth. But if we go back to fundamentals where savings, once again, fuels growth, that's kind of what we had in the 1950s, then that would be very bullish in my view. That's a very strong economic fundamental that would make the growth, much more sustainable. And it would also lower inflation at the same time. Stronger dollar, lower inflation as a result of all of the above. However, the one bearish aspect of the Trump agenda, mass deportation of illegal immigrants, if we end up, deporting millions of people, even if it's for the right reasons, right? Not to get into the politics of that, but, again, just economics 101. If we reduce the population, that reduces both consumption and production by removing the supply of labor, and that reduces the economic output. So, just by itself, it is a negative if that ends up happening. We'll see if Trump ends up deporting that many people. But if the number is a little bit more benign, like in the hundreds of thousands rather than in the millions, that would be, much more palatable, I believe. So we'll see where that happens. This is in the news, but in my view, do not fear the tariff. It's just meant to achieve the Trump agenda, like these things that I've listed out here. Tariffs are just there to negotiate better terms or to encourage companies to circumvent the tariff by direct investing in the U.S. for manufacturing and hiring. Tariffs are the cornerstone of Trump's economic policy, but remember, it's not there to actually be paid. It's there to encourage more U.S.-centric business formation, more U.S.-centric foreign direct investment, more U.S.-centric manufacturing, or to get foreign governments to give us better deals, to make U.S. exports more attractive abroad. Either way, that would be bullish for U.S. companies. And remember, under Trump, the first 4 years, we actually doubled tariff revenue here. So not to say that nobody actually pays the tariff. Certain things may be tariffed and yet still make it, relatively more attractive to build abroad than to build it here. Remember, tariffs, although they were doubled, right? Tariff income doubled under Trump in the first term, but it had no meaningful impact on CPI. So I would not, automatically connect tariffs with inflation, especially if they are targeted in nature. So right now it sounds like tariffs are broad-based, but remember, they're just there to achieve Trump's outcomes, which is a negotiation tactic in order to secure more favorable trade deals with nations. Now, tariffs are anti-growth and inflationary if the goal of the policy is to actually extract revenue, meaning if he puts it there and makes it broad-based, regardless of what happens, then that would be anti-growth. That would be inflationary. Like if he woke up and said, all right, we're going to make these 25% tariffs on Canada permanent, if we're going to make a 25% tariff on China permanent. That would be bearish. That would be anti-growth. But if the tariffs are just broad-based in order to extract some outcome, that is not going to be long-term inflationary. That will not be long-term anti-growth. In fact, it would be pro-growth. Because the goal of that is to force foreign countries to reduce their import tariffs on American exports. That would be very bullish. Tariffs can also be pro-growth if they successfully convince companies to invest in America. That would be bullish. So ultimately, the point of high tariffs is for very few companies to actually pay them, because they successfully open up new geographic markets for American companies to sell into, or to incentivize companies to manufacture in the U.S. So this becomes even more bullish for U.S.-based capital investment and hiring if the policy is paired with favorable tax rates for businesses. So if that happens, again, I think this is a very bullish outcome, not a bearish one. So I would not fear tariffs in and of themselves. Always view tariffs as a way to secure better deals for us. But remember, the number one risk in my view are deportations. If we are deporting people in the millions, that would be bearish. But if they are a lot more gradual, and if they're in the hundreds of thousands, then that I think would be a much more palatable without delivering a hit to GDP. And so now, as I no longer believe that recession is the base case, it makes sense to remain long the S&P, but I still favor the Zacks Earnings Certain and the Zacks Deep Value portfolio. So if you're not familiar, we launched a new portfolio called the Zacks Deep Value portfolio. And just in a nutshell, the ECP, the Zacks Earnings Certain portfolio, is our portfolio of high-quality, steady compounders. These are companies that are unaffected by recessions, companies that historically have been unaffected by macroeconomic volatility. So if you're worried about that, the ECP is the portfolio to go. And the new portfolio, the Zacks Deep Value portfolio, are high-quality cyclicals. So not quite steady compounders, but they are cyclicals, much more mature businesses, but companies that we believe are priced very, very attractively. These are companies that have gone through deep multiple compression and therefore are highly probable to experience outsized returns as the multiple reflates back to long-term averages. So we're very bullish on both of these portfolios here, but they do take very different strategies. The deep value portfolio, these are not, the steady compounders that you're used to seeing from the ECP. They are cyclicals, they are mature businesses, but we do have, a rigorous standard when it comes to picking cyclicals based on high quality characteristics. We want to look for companies that have high degree of high degree of profitability, high ROIC companies, but companies that are ultimately cyclical in nature and currently are going through a deep compression in their earnings multiples, which means that they are companies that are possibly ripe for investment now, and could be the epicenter of where the key beneficiaries are of the Trump agenda. So the takeaways here, the S&P trades at a very elevated 22.5 multiple, with very bullish growth expectations. The bar is extremely high. Right now, we're in the top decile of valuation multiples over the past 30 years. As such, the forward earnings yield of the market is basically at parity with the 10-year yield. Historically, the market returns over the following 5 years have been very poor at these levels. However, ISM Manufacturing, as I said, looks like it has turned a corner, which would be very bullish for S&P cyclicals. If cyclicals finally return to earnings growth, then the breadth of the market could expand dramatically, making the current market valuation not as expensive as it may seem. Again, because if we get earnings growth expand from just the 7 companies right now to the next 100 companies that are cyclicals, we would see a big increase in market breadth. And if we see an increase in market breadth, you will see earnings grow, and therefore earnings will grow into the multiple that the market currently trades at right now. So that may not be bearish at all. In fact, that would be bullish. So remain long the S&P 500. But again, I would put a tight risk management principle on it. If it remains above the 100-day moving average, the EMA, stay long. But in my view, the best gains over the next 4 years are going to come from high-quality cyclicals with strong balance sheets, high returns on capital, and attractive valuations. And that is ultimately the Zacks Deep Value portfolio. So here, again, is the Zacks Earnings Certain Proxy. These are, again, recession-resistant, durable, moat-protected, low volatility, steady compounders. These are companies that do well in all markets, regardless of if we're in a bear market or a bull market. I'm very, very bullish on these companies. I love this portfolio, this strategy. You can see some of the companies that we own in the portfolio. Very bullish, very steady earnings growth through basically all market environments. I love that approach. Built for long-term durability. So again, I'm very much still bullish on this portfolio. It is a collection of 68 companies, but we have distilled it down to a more manageable 30 companies. That's called the Zacks Admiral Proxy, the Zacks Earnings Certain Admiral portfolio. So those are 30 companies to make it much more palatable. And then here are some of our top ideas in the Deep Value portfolio. These are much smaller companies. A lot of them are much more U.S. centric. So that again would be very bullish in a Trump agenda, whose sole goal is to benefit. One of the top beneficiaries in our view of the Trump agenda is domestic cyclicals, domestic companies focused on domestic manufacturing, domestic hiring, and exports. These are the companies that will benefit the most under the Trump agenda, especially the ones that have had the biggest multiple compressions. And these are the companies that we have identified, among many others, that fit into that category. High quality, cyclical, U.S. specific companies that have undergone deep multiple compression. And so with an earnings recovery would come outsized gains. And so these are some of the companies that are in the Zacks Deep Value proxy. So for more information on either of these two strategies that we run, please do reach out to us. I'd love to hear feedback, thoughts, questions, anything that you have in mind. Please do reach out to us with that. You can reach us at 1-866-794-6065 or send us an email to strategycall@zackspro.com. So once again, I'm your host, Mayur Thaker. And if you, again, any questions or comments, feedback, please do reach out to us. Hope you found this helpful, and we will see you on the next webinar.